Hello, everyone, and welcome to the iSectors Market Review for the third quarter of 2023. I'm your host, John Koch, Senior Investment Analyst at iSectors, and I'm joined, as always, by the CEO and CIO of iSectors, Vern Sumnicht. In this short video, we'll walk through a brief outlook on our current views of the economy and what our research is telling us about the markets going forward. We'll also briefly touch on third quarter performance of the iSectors models, along with a quick rundown of some changes that were made last quarter in our fixed income models. As a reminder, if there's anything we don't touch on today, you can always view the full performance data on our website or reach out to us directly with any questions or concerns. So, without further ado, let's dive in. I'll hand it over to Vern to start with a discussion about how modern monetary theory has shaped the current state of financial markets.
Right. Thanks, John. As John said, I want to take a look at it, the macroeconomic environment a little bit, and then John will discuss a little bit more about the details of how this has affected some of our models. So, modern monetary theory, I think, as everyone's already aware, is kind of taken over the world's central bank and government view of monetary policy. Modern monetary theory more or less believes that government can print money and increase debt with no repercussions, right? It's not going to cause any problems. But modern monetary theory has really led to greatly increased national debt, which has led to greatly increased money supply. And that's led to inflation. And unfortunately, that's led the Federal Reserve to try to fight inflation with higher interest rates. And these higher interest rates are causing a significant increase of in the cost of business. We want to talk about how gold miners have run into an increased volatility relative to the gold bullion, and we'll talk about that more in a little bit here. But first, let's take a look at how modern monetary theory has really increased national debt. This graphic from the Federal Reserve shows us the increase in national debt versus GDP. And we're looking over the last 30 years, and you can see that up until 2008, which was really the financial crisis, the national debt as a percentage of the GDP was pretty flat. And since then, and maybe necessarily so, I don't know, but we've seen this rapid increase in debt, especially as a percentage of GDP. It's a real increase, and it's very significant. And then again, we had a very sharp rise during COVID, but we're still running at 120, 125% of GDP. And that is significant. And as I said, that's led to a number of issues. Let's move on to the next slide, John. Mm-hmm. Taking a look at how this increased the interest rates, and that's increased the cost. So we've spoken about this before. We want to just get into a little more detail on it here. And then there's even more detail in our written quarterly commentary. So if you're interested, please take a look at that. But the use of mining stocks as one of the investment options in our post-MPT allocations, we've noticed that it's increased the volatility because of the cost of doing business, right? So as the gold miners have a higher cost of capital, a higher cost of fuel, a higher cost of labor, all of these things are increasing their costs, which is increasing the volatility of gold mining equities. And if we look at how gold bullion has reacted, we can see that as far as returns go, gold bullion and gold equities get to the same place, right? The average annualized returns over this period, like that we're looking at here in the graph, shows that we get to the same place. But I think what's really noticeable is the volatility in gold miners relative to the volatility of gold bullion. And we've looked at other things to see if they're affecting our models and what they're affecting, how they're affecting our models, like short-term bonds versus long-term bonds. And it really doesn't make much difference over the longer term. But what does make a difference, because our models are continuously looking at not only return but volatility, is taking out the volatility. And so we really know that modern monetary theory is a driving force in this volatility that we're seeing with the gold miners relative to bullion, and that taking out that volatility allows our models to not be as concerned about volatility. So this concern has caused the models to put long-term bonds in the portfolio to reduce volatility. If we take those out, we take that volatility out, it reduces our allocation to long-term bonds, and that allows us to add things like healthcare as an example to the portfolio. It allows us to add other volatility, but with higher returns, like healthcare. So I think John can get into more detail here about how things have affected our models and changes in our models.
Yeah.
So John, you want to take it from here a little bit?
Yes. Thank you, Vern. That was good. Yeah. So on this page, you'll be able to see exactly what Vern was talking about in our most recent allocations, our most recent model runs of the post-MPT allocations. You'll be able to see how the models are handling exposure between gold, long-term bonds, and the other equity-like asset classes in the model, like healthcare, like Vern mentioned, as well as technology. So post-MPT growth has remained invested largely the same as previous months, with an increase in energy holdings this quarter and a reduction in healthcare as really its biggest change over the last quarter or so. Otherwise, it's been invested mostly the same. However, as Vern sort of alluded to earlier, post-MPT moderate, on the other hand, has seen one of its biggest allocation changes in some time. Now, both models have very low exposure to treasury bonds, as you can see, but moderate and low exposure, that actually means no exposure to treasury bonds. This is the first time since 2010 that post-MPT moderate does not have any exposure to long-term treasury bonds. And we believe this is a direct result of that gold miners to gold bullion switch we made earlier this year that Vern mentioned. And so, speaking of gold bullion, both models now have stuck with a near maximum weighting of 30% gold bullion. 30% is the maximum position weight for gold. They've both been around 30% for the last few months, really the last 4, 5, 6 months, as a way to offset the pure equity exposure that they both currently have in technology and healthcare. And now, so these last few months for gold have been challenging, but so far in October, we're starting to see the benefit of holding steady to this high gold allocation as geopolitical uncertainty has ramped up, certainly more so than it has since early 2022. And so going forward, we're very comfortable with the diversified nature of both of these models and the current split between gold bullion and equities, mainly with the main exposures being technology and healthcare. We feel that they're prepared to handle any market volatility, upward or downward, going forward in the face of MMT, the wars in the Middle East that I mentioned, a strong dollar currently, and the Fed's higher for longer interest rate policy, which seems to be the driving factor of markets heading into 2024. And so, speaking of the Fed's higher for longer policy and higher interest rates in general, I'd like to shift the focus now to our fixed income models. This last quarter, we made slight changes to both our capital preservation and domestic fixed income allocations. In both models, we slightly increased the high yield exposure while also adding to the treasury bond allocation at the same time. This came from a reduction to investment grade corporates in domestic fixed and a decrease in mortgage-backed securities in capital preservation. The result of these changes is that both models are now paying an even more attractive yield than they were before, net of iSectors fees, while at the same time maintaining an average credit rating of upper investment grade, as you can see in the table on the right, A+ for capital preservation and A- for domestic fixed. Both of these models have fairly low durations, with capital preservation being in about its normal range of 1 to 2, sitting at about 1.4 right now. Capital preservation is usually lives in that 1 to 2 range, while domestic fixed is currently positioned quite a bit lower than its target duration range of about 2.5 to 3. That's also at about 1.4, a little bit higher than capital preservation, but very close. In the process of our analysis last quarter, as we were going through and looking at these models and doing the deep dive that we do, we came to the conclusion that at this point in time, in the current environment, there was just not enough of a yield advantage to going further out on the curve and extending duration at this point in time. It would really only be exposing the portfolios to unnecessary downside risk in this higher for longer environment that we're living in. And so now on this chart, I want to highlight the advantage of investing in a model like domestic fixed income, a model that has relatively lower duration, as we saw, a higher yield, 5.9% net SEC yield. I'll go back to that chart quick, actually, just so that 5.3% net SEC yield for capital preservation, 5.9% net for domestic fixed income. And so the advantage of investing in a model like that over the last 3 years at least, lower duration for domestic fixed, that higher yield and an A- credit rating, you can see domestic fixed income in the lighter blue line on the top, compared to a couple other popular bond indices, has performed much better. We have the Bloomberg aggregate in the red, the Bloomberg US Gov Credit 1 to 5 year in the yellow, and the Bloomberg US Government 1 to 3 year in the dark blue. All of these indices, I mean, we know the struggles that the Bloomberg Ag has had over the last few years, but even the other two indices, shorter term government exposure, they haven't even had a positive total return over the last 3 years. On this growth of 1,000 chart, you can see that domestic fixed income would be the only investment among these choices to have a positive total return over the last 3 years. So now moving on to the rest of our models and then sort of the broad markets in general. In the third quarter of 2023, almost no asset classes had positive performance except for commodities, driven mostly by oil prices, and short-term bonds, which we already hit on in capital preservation and domestic fixed income. The interest rate increases last quarter and more hawkish Fed speak kind of negatively impacted everything across the board. You can see that in the chart on the left in the third quarter. The only asset class here with positive returns was commodities, like I mentioned. And so it was a similar story for the rest of our models in the third quarter as well. Everything struggled mightily, but even with that, over the last year, which is what we're showing on the right, the table on the right, almost all of our models still have positive performance over the last year. And I'm highlighting a couple here that have beat their benchmarks. Some of our models that have been performing the best over the last 12 months. Capital preservation, like I mentioned, is beating its the Bloomberg 1 to 3 year government index. Domestic fixed income also beating its Bloomberg aggregate index handily, like we saw. That was evident in the chart I showed earlier. And also our alternative suite has been performing well against their respective benchmarks. The inflation protection allocation is beating the CPI, which is its benchmark over the last year. Liquid alternatives is performing relatively well compared to the HFRX Global Hedge Fund Index, which is its benchmark. And precious metals as well, which is much more hyper-focused on the precious metals themselves, gold, silver, platinum, and palladium, is beating CPI, same index for inflation protection as precious metals. And so if you want more in-depth discussion about any of these models or want to see different time periods, returns over different time periods, you can look at our written commentary that's on the website, or the fact sheets are on the website as well. The updated third quarter fact sheets will give you, any of the time periods you want to see. It'll all be in there. As well as in the written commentary, like Vern mentioned before, we go a little bit more in depth on the gold miners versus gold bullion debate, and you'll be able to see, what has been causing some of the, what's driving the returns of the models in recent periods. So with all that being said, that's everything that we have for you today. And as you carefully inspect the disclosure page, I want to thank Vern for his time today as well.